Quick disclaimer, this is not financial advice, just filings and math. IBM just had its worst trading day in 115 years, down 25% in hours, $290 to $217. The CEO didn't spin it. He said, quote, "We faltered. If you want the real numbers behind the panic, hit like and let's get into it." IBM has been public longer than almost anything on this channel. Founded 1911, 264,000 employees, 4 segments today: software, consulting, infrastructure, and financing. $69 billion in trailing revenue. This isn't a startup story. It's one of the oldest companies in American tech trying to prove it still moves fast enough. Volume tells you this wasn't a few nervous traders. 6.5 times normal, that's institutional money moving. The stock broke below both its 50 and 200-day averages in one session. Support sits at the 52-week low, 212. Resistance is the old range, 279 to 290. The gap this stock needs to fill to recover. Until then, the trend is broken. Strip out today's headline, and the trailing 12 months still look fine on paper. $69 billion in revenue, growing almost 10%. $12.5 billion in EBIT, an 18% margin. $10.8 billion in net income. Nearly $13 billion in free cash flow. This is a profitable, growing business having one very bad day. Here's the part value investors will flag. More than half of IBM's balance sheet, 57%, is goodwill and intangible assets from years of acquisitions. Total debt sits at $66 billion, net debt $55.5 billion, against $33 billion in equity. This is a company that grew by buying, not just building. Operating cash flow, almost $14 billion. After capital spending, free cash flow lands at $12.9 billion. But stock-based compensation eats $1.8 billion of that, 17% of net income. Owner earnings, what's actually left for shareholders after dilution, comes out to $11.1 billion. Still strong, just not as strong as the headline free cash flow number alone. Software is IBM's crown jewel, 83% gross margin, and it grew over 10% last year. Infrastructure, the mainframe business, actually grew 12% in 2025. But this quarter, preliminary numbers show infrastructure down 7%. That swing from growing double digits to shrinking is exactly what triggered today's crash. 19 times earnings, 20 times EBIT, 6% free cash flow yield. Cheap for a technology company if the growth holds. But analysts are split hard, and both moves happened today. HSBC cut IBM to reduce, target 191. Oppenheimer raised it to outperform, target 350. Same day, same data, opposite conclusions. The bull case doesn't ignore today, it looks past it. Red Hat growth just accelerated to 11%. Distributed infrastructure had its best quarter ever, up 37%. The Z17 mainframe program is outperforming its predecessor. And IBM just committed $10 billion to quantum computing over 5 years, plus a separate foundry deal backed by the Department of Commerce. The core business didn't break. One quarter did. The bear case takes the CEO at his word. Large deals failed to close. That's an execution problem, and execution problems repeat. Layer on $66 billion in debt, a balance sheet that's 57% goodwill, and real dilution from stock compensation. HSBC's take is blunt, that you could assemble IBM's same exposure from other stocks for less money and less risk. Run it through gold, and the picture doesn't change. And that's the point. At $4,039 an ounce, IBM went from about 0.07 of an ounce a share to about 0.05. Same 25% hit. Worth noting, gold itself is down almost 28% from its own January high. Hard money isn't standing still either. The damage was real in any currency. Valuation, pass at 19 times, cheap if growth holds. Balance sheet, watch, 57% goodwill and intangibles. Margins, pass, 18% EBIT. Revenue growth, watch, decelerating into the quarter. Smart money, split hard, same day, same data. Opposite conclusions. Risk, fail, the worst day in company history. Added up, that's a watch verdict. The earnings power is real. So is the execution problem. I show you the data, you make the call. So is this a panic sale or a warning sign? Probably both. The cash flow is real. So is the execution problem the CEO just admitted to. I'm not calling this a buy or a sell. I'm calling it a name to watch into the July 22nd earnings call when we get the actual numbers instead of a preview. See you in the next one.